Hey traders, Alex Ong here and welcome to today's Trader Q&A. Now this is a show that my brother and I decided that we would put together because over the years we've created so many different educational videos where we teach you strategies, sort of different trading techniques, psychology, all of that kind of good stuff. But we kind of felt that there was a lot of that already out there and there wasn't enough of just basically answering the questions from our viewers, from people like yourselves who are in the markets every day trying to make money, trying to take that step towards professional trading, or at least subsidizing your income significantly from your trading efforts. And there are a number of questions out there that won't necessarily just be about a strategy or an indicator or stuff like that, although there may be that stuff. So basically we put this together so that we could answer all of those questions, whatever it be, whether it be about, when should you draw profits, the transition from amateur trading to professional trading, all of that kind of good stuff. We're going to answer in these videos right here. So in today's show, we've got five questions from 4 people. The first one is from Roger, and he asks, if you're trading for 2 hours in the morning, what's an appropriate number of markets that you should watch, and how do you decide which ones to look at? So from my perspective, if you've only got, let's say, 2 hours to trade in the morning, and I'm assuming that Roger's asking about day trading, really and truly, day trading is quite an intensive activity. So I wouldn't recommend that, you look at too many markets. I personally, when I'm day trading, I focus on one market, which means that I've got my screens and everything is up on just the DAX. That's what I'm watching 90% of the time. Now, if the DAX isn't moving, then I will kind of flick between some of the other FX charts, some other commodities and things like that. But my primary focus for those 2 hours that I'm trading is going to be one instrument, because that instrument moves very, very quickly, and it's very, very frustrating if that's your window of trading time. If you kind of flick to one chart and you spend 2 or 3 minutes looking at another chart, and then the one that you sort of been focusing on suddenly moves, you've potentially missed the only trade for that day. So I really would say that sort of just start by looking at one instrument if you're day trading, because it is an intensive activity. If, of course, that particular instrument isn't moving very much, then feel free to look at other instruments like other currency pairs, other commodities, things like that. That's absolutely fine. But obviously just kind of keep it focused to start with. Once you get a bit more experience, then of course you can look at other markets, certainly. In terms of how do you pick which markets to look at? Well, if you've got a short period of time, one of the things you're going to want to do is look to see what it is that moves during that time. So there's no point in, let's say, trading, the Asian markets during the European session, because it's just not going to move. So that's one of the criteria you're going to look for. The other is obviously going to be to make sure that it is a volatile market anyway. So if the market, if you're trading at a European stock during a European market, that's fine. But you need to make sure that it actually does move. You don't want to be trading something that just kind of meanders around and goes sideways, and you spend a lot of time not doing very much. Okay? The next question is Duncan, and Duncan says, my question for the Q&A is about the best way to add to winning trades. Said, rarely that happens, but we can all live in hope. So how and when do you add to winning trades? Well, from our perspective, we add to winning trades. They're mainly longer term trades, to be honest with you. So trades that we might be taking over a few weeks or maybe a month or so. But we'll add to winning trades primarily when we have a fundamental driver. So when fundamentally we believe in a particular trade and we've got all of our reasonings for that. So we've got a little bit more of a longer term view on the markets, then we're going to be more comfortable adding to winning trades. So if you're looking at it from a technical perspective, you would be adding to winning trades with a big, humongous trend behind it. You don't want to be adding to winning trades if you're sort of in a tight, narrow range and the market's not really going anywhere. Okay? So I hope that answers the question. It's not the easiest thing to do. I understand adding to winning trades is a difficult one, because you think, well, I've already got all of this profit on the table. If it now turns around and stops me out, I'm not only going to be stopped out on the initial position, and I've now going to eat into all of my profits because I'm adding another position here as well. So it's a tough thing to do, but to be honest with you, when you do it and you get it right, it really can provide some quite significant profits for your trading account. So it's definitely something you want to, pursue and continue to look into. The next question is from John. And John says, after drawing, for instance, a support line, do we enter a short bet immediately, or do we wait for a price to break through, say, 5 pips before entering? Now, this is a really, really good question. Unfortunately, there's no sort of hard and fast rule because it's going to depend on a number of things. You could say wait for 5 pips beyond the close of the candle or beyond the break, and that's absolutely fine. But if you were trading a very, very volatile pair, 5 pips might not be enough. Also, it depends on the time frame that you're trading. So if you're trading a daily chart, 5 pips, that's not that significant a movement at all. Whereas if you were trading a 5-minute time frame, then 5 pips, you might already have given up all of your profits. The way that I personally enter trades on breaks is I'm almost immediate, to be honest with you. So once it's gone through the line, I'll wait maybe 2 or 3 pips and I'm in the trade. Now, that doesn't necessarily mean that I'm going to sell directly through the support line. What I might wait to happen is for the market to break through the support line. And then once it's broken through the support line, you can wait for it to then maybe pull back and retest that support and treat it as resistance and then break again. So you kind of wait for the second break, if that makes any sense. So it breaks through support, it holds, spends a little bit of time beneath support, it then breaks the new support, the sort of temporary intraday support, if you like, and then I'll be getting in there with sort of, a couple of pips and I'll be in that trade. So in answer to your question, there's no sort of like hard and fast set of rules for getting into the market. What retail traders really need to understand is that there's no guarantee with any of your trades. And I think that's what a lot of people look for. So when they're saying, do you wait 2 pips or do you wait 3 pips? Ultimately, it doesn't matter. If you've got the direction right, you've got the direction right. If you've got it wrong, you're going to be stopped out whether you've waited 2 pips, 3 pips, 4 pips, 5 pips, 10 pips. You'll be stopped out eventually if you're in the wrong trade. So, the best advice really is to do your analysis beforehand. Make sure that you're in the right trade to start with. And if you're in the right trade to start with, then the entries to a certain extent become sort of a little bit arbitrary. Okay? The last question is from a gentleman called Coffee B, and he asks, Fibonacci extensions, what are they used for? And is it possible to have fib retracements and extensions on the same settings? Yeah. First of all, I personally don't use Fibonacci extensions, to be honest, but I do know people who do, and they use it quite successfully. People use extension levels either for opportunities to look for reversals. So, if you get the market sort of overextend itself, people use Fibonacci extensions to use that as sort of like opportunities to go against the trend, go against the momentum of the markets. Other people use extensions as profit targets, which is fine too. That's absolutely something that you can utilize Fibonacci extensions for. I personally prefer looking for actual support and resistance levels. I don't mind Fibonacci levels if they're used in conjunction with support and resistance levels, but I personally don't like using Fibonacci just all on its own, all on its own. It's not something that I believe in. It's not to say it's not profitable, but trading is a psychological endeavor, so you really have to believe in what it is that you're doing to be able to trade it through thick and thin. So the way that people do use extensions is either for reversals or for profit targets. I personally don't use them. And then Coffee that goes on to ask a further question about the rumors of the Bank of Japan intervening again. Will the yen then start rallying north again? Well, first of all, we sent out an email earlier on in the week where Nikki did quite a lot of analysis behind this. And also we talked about it in the Forex Focus last week, I think, where we said that ultimately we think that the dollar yen is going to rally at some point. So we're just looking at sort of like buying opportunities, whether it goes through the highs or whether it comes back down towards the 100 level. We think it's going to rally anyway. In terms of intervention, now this is something you need to be very, very careful of, because when the Bank of Japan intervene, they do move the markets. They move it very, very quickly. However, However, when the Bank of Japan do intervene, it's a little bit short-lived unless there's a lot of substance behind it. So if you go back, maybe where are we, 2016, so 5, 6, 7 years on your charts, and look at a dollar yen chart, right? And you'll see these big spikes in the market. So you'll see the market, rally 100, 200, 300 points overnight. And then look at the price action that follows it. It falls away somewhat, and then you pretty much get a retracement of that whole move. So if we don't have other fundamental reasons for wanting to be long, which we do at the moment, but if we didn't have, we would actually use those intervention events as opportunities to sell against it. So we'd wait until the Bank of Japan intervene, and then we would just sell against it, because more often than not, the market then just retraces. The markets, they're smart. They know when a bank is just trying to, if they're doing something temporarily and they're not going to follow it up with much, and they'll just use that as opportunities to make profits on pretty much dead cert trades. Okay, so that wraps it up for this week's Trader Q&A. There are no other questions here. We have lots of other questions that we still need to get through, as I said in the initial Trader Q&A, and we are going to attempt to do that as we go throughout the shows. Please don't use that as a reason to not send us other questions. Send us as many questions as you want, and we will get through all of them eventually anyway. Okay, so thank you very much for watching this week's Traders Q&A. If you liked it, please give it a thumbs up. Subscribe to the channel. Okay, let us know that you like the videos that we're putting up there by subscribing. It will just encourage us, motivate us to put more out there. Otherwise, thank you very much for watching. I hope you enjoyed it, and I'll see you in next week's Trader Q&A.